Recording in progress.
So what was the concept which we are discussing in the last session? Yes, I will be starting with IRS formula. Okay, very good. Can anyone give a brief about IRR? What exactly IRR means? I believe we had a discussion on the internal rate of return. Can anyone, in your words? Yeah, I started the topic, correct? And I believe I already explained the basic or nothing but I already introduced the IRR concept to you. So here I'm getting some answers. Break-even cost of capital at which NPV is equal to 0. Very good. Yes, Leela, NPV is equal to 0. Now what NPV means? What exactly NPV 0 means? Suppose let us assume that I don't know what exactly NPV 0 means. Can anyone let me know? NPV 0 in the sense? Break even. Yeah, it is break even. See what I mean. But what I am expecting is when NPV will be 0. Project is only capable of covering the funding cost. Yes, yeah, certain extent. Yes, I agree with you, Farhan. Next, other answers. Earning is equal to cost of capital. Absolutely correct. It means it earns exactly the cost of capital. There is no positive or negative. Very smart answer, Kavya. When inflow and outflow will be equal. Yes, Sadika, this was the answer which actually I'm expecting. Perfectly correct. Yes, when inflow and outflow will be equal. Just I want to add two more words to this. NPV will be 0 is nothing but it is the point at which the present value of expected cash inflow is equal to the cash out. The present value of expected cash inflow is equal to cash outflow. That is known as a point at which NPV will be 0. Because this question which I asked, definitely you can expect as an MCQ. So do remember. So when NPV will be 0, the present value of expected cash inflow is equal to cash outflow. Suppose if I am investing $1 lakh in a project and if I am expecting the project to give a cash inflow of 25,000 per annum for a period of let us assume that 8 years. So the present value of that value. So if you convert it into present value and if you get same 1 lakh which is our cash outflow, then we can say that our NPV is equal to 0. And I appreciate the participants for giving the answer for IRR. Yes, as you rightly said, IRR is nothing but uh, it is a break-even rate at which the present value of cash inflow is equal to the present value of cash outflow. Very, very good. Yes. So I hope you understood it. And why we generally calculate IRR? Can anyone? Why? What is the reason for calculating the IRR? What is the purpose? Now, why we should, as a finance manager, why I need to go with internal rate of return? To access the feasibility of the project. Very good. To access the yes, in order to know whether the project is feasible or viable or not, we will be knowing that. And yes, perfectly correct. And generally, the main objective of calculating IRR is whether the project is capable of giving a return which is at least equal to the cost of nothing but in order to compare the return and the cost of capital. Now, here cost of capital is nothing but whatever rate at which we borrowed the funds. In order to start a project, we need the funds. Now, definitely we will be borrowing the funds. So at what rate to borrow the funds? Suppose if you borrow the funds at 9%, and what is the expected return from that particular project? So always we prefer or always we assume the project is feasible when its IRR is more than the cost of capital. Once again, I repeat, we assume that the project is feasible if IRR is more than the cost of capital. And again, if you can recollect the last session, we clearly understood that always the company need to go with a minimum cost of capital. It means that if they acquire the funds or if they procure the funds with high cost of capital, there are greater chances that your NPV will be negative. Or technically speaking, you can't expect the project to be feasible if you mobilize or if you procure the funds at higher cost of capital. So the major reason for calculating IRR is to know whether the expected return from the project is more than the cost of capital which we incurred to procure the funds. I hope the basic about IRR is clear. Before going with the discussion of a problem, I believe the basic concept introduction about IRR is clear to all. And yes, in the introduction, around 95% of the answer is given by the participants only. So very good. Okay, now shall we go with the calculation of IRR now? Now once again, just I'm projecting the formula. So we will be considering two discount rates. We will be considering the two discount rates by calculating the IRR. So lower rate of interest we do consider and higher rate of interest. And then we will be calculating the NPV at lower rate of interest and NPV at higher rate of interest. So it means that the first step in calculating the IRR is calculating the NPV at two different discount rates. Okay, we will be calculating the NPV at two discount interest rates. After that, we'll execute this particular formula. Now let me open my Excel sheet. Now one more point I want to make it very clear. Generally do remember it is very difficult to get the exact IRR. Once again I repeat. So it means that in order to get the exact IRR, we need to apply the formula in our Excel sheet. But do remember this particular functionality, this particular function is not available in your ACCA exam platform. It means that there is no functionality of calculating either NPV or either IRR in your spreadsheet in your exam platform. So that's why do remember here the simple technique which we need to adopt for calculating IRR is just take two discount rates, one lower rate and one higher rate, and apply it in the formula. That is nothing but your IRR. It is not necessary that you need to get the exact value of IRR, because for that you need to depend upon the IRR functionality in the Excel, and this is not what is this considered for the financial management. So no need to think about this because the functionality is not available in the platform. So no need to consider this. Okay. So first we will be discussing the procedure. So investment 1 lakh. I hope everyone can see my Excel sheet. Discount rate 8%. So discount rate 8% and 10%. Yeah, here we need to memorize the formula, Joel. So there will not be any formula sheet given during that. Okay. So you should memorize this form. For AFM Advanced Financial Management, yes, they will be giving the formula. Formula sheet will be given. So let us assume that the time period of the project is 5 years. Then cash flow. Yes, as I said, so two discount rates are given, 8% and 10%. So first we consider 8%, then we'll go with the 10%. Okay. So discount rate at the rate of 8%. So can anyone help me out in formula? What is the formula? What formula I need to apply for calculating the discount rate for the first year? Of course, we can go with the present value table. Yes, I agree with you. But formula, how to go with this? 1 divided by 1 plus r whole to the power of n. Very good. So 1 divided by 1 plus r, that is 8%. So whole to the power of n is nothing but for the first year it will be 1. So just I am not taking any power. So its value will be 0.925. And the second year, then third year, and the last year. So then I need to calculate the present value. Present value at 8%. So how we will be getting cash flow into discount rate. Whoever missed the previous session for calculating this, just see this. The present value at 8%, we need to multiply the cash flow into the discount rate. So cash flow is 25,000 and the discount rate is 0.925. So our present value for the first year will be 23,148. And this particular copy function is also available in your exam spreadsheet. So here you can just copy the formula. This time I'm copying this and just paste it. So this particular function is available in the exam spreadsheet. So no need to give the formula for the remaining periods because I already gave the formula for the first year. This I copied and I pasted for the remaining 5 years. So this you can do it in your exam. And the total present value. So sum and one more thing, if possible, uh, if you can do this in your Excel sheet so that you will be having certain practice also. Okay. instead of doing these calculations in your notebook, if you do have a laptop, so better, or if you do have a desktop in your house, so please use this Excel sheet. Okay. So we done the present value for the 8%. Now we need to calculate the discount factors at 8%, 10%. I hope present value calculation for 8% is clear. Yes. Now the discount rate for 10%. 1 divided by, then similarly I need to go for remaining periods. Now the present value, at 10%. So here we need to multiply the cash flow and discount rate for 10%. So cash flow is 25,000 and the discount rate at 10% is 0.90. So just copy it. So these are the present values at 10%. Then total. Now we got this. So first thing is we should calculate the NPV at 8% and NPV at 10%. So NPV at 8%. So what is the formula for NPV? What is the formula? Anyone? Sum of present value. Very good. Sum of present value. Next. Is it only sum of present value? Net present value. What is the formula? Minus investment. Yes. So from this we will be deducting the investment. So at 8%, the sum of present value is 1,72,658 minus our investment is 1 lakh. So NPV at 8% we got 72,658 and at NPV at 10%, so the present value at sum is 1,62,360 minus 1 lakh. So we got NPV at 8% and we got NPV at 10%. Now we need to use it in our formula. So once again, just I am displaying the formula. You can see L plus NL divided by NL minus NH into H minus L. Nothing but lower rate of interest. So here our lower rate of interest is what? 8%. Our lower rate of interest is 8% and higher rate of interest is 10%. So first we need to take L, that is lower rate of interest, plus NL, nothing but NPV at lower rate of interest, and we need to see the difference between the lower and higher and divided by H minus L, that is higher rate of interest minus lower rate of interest. Now let me apply the formula. So lower rate of interest is 8%. So whoever misses the formula, once again I'm projecting this. I hope you can find this formula. Okay. Or let me do this. Yes, just see this is a formula. So NL, that is NPV at lower rate of interest. So we got it as 72,658 divided by difference between this. So NPV at lower rate of interest again 72,658 minus NPV at higher rate of interest 62,360. Right. So I hope up to here it is clear. Then difference. So what is the difference between higher rate and lower rate? So the difference in this is 2. So 10 minus 2. 10 minus 8. So it will be 2. One second. So our internal rate of return would be 22.11. Is that clear? Any question on this? So let me know if you have any question. So just I'm displaying the formula. I just highlighted the formula. You can see. Yeah, definitely. I will be showing the whole working. Once again, I repeat it. Don't worry. Yeah. So first step, as I mentioned, we should calculate the net present value at lower rate of discount and higher rate of discount. So that should be the first step. And so here you can see the working for calculating that. Here you can see this. So cash flow, discount rate and present values. And we calculated the sum of the present value. So here you can find this. And one more thing, in your exam also, these main key information. So whatever key information which we require for our formula, so try to put it in bold. Okay. So here you can see. So that examiner will be knowing that it means he can easily identify the key information. Okay. Yeah. So as I mentioned, so first we should calculate the present value at lower rate of interest by considering the discount factors. Then similarly, present value at higher rate of interest. Yeah, here anything you can go with this. It means that either you can consider the percentage or you can go with the decimal also. See, now suppose let me show here the formula. Instead of 8%, you can consider 0.8 0.08. Okay, then you can go with 0.08. So here also difference 8% minus 2%. Okay. Yeah. So as I mentioned, the first step NPV at 8% and NPV at 10%. Then you should be very careful when you are applying the formula. See, here very easy to memorize the formula. See how we can do this is, first we need to take lower rate of interest, right? Then we need NPV at lower rate of interest, and we should divide by the difference between lower rate and higher rate, and multiply with difference between lower rate of interest and higher rate of interest. So here you can see, first we will be taking lower rate of interest, that is 8%. And this is the NPV at lower rate of interest, and the difference in the NPV with lower rate and higher rate. Then the difference between lower rate and higher rate, that is nothing but your I. So here one thing is, I want everyone to practice a question. I will be giving a small query. So shall I give a small illustration? Will you try? Just once try it. If you have any query, you can get that. You can ask. So before that, if anyone want me to explain any specific part, let me know. I believe NPV calculation, I don't think it would be a problem for you. But here only thing is, we need to calculate the NPV two times. NPV at lower rate and NPV at higher rate. So that information we will be just executing it in the formula. That's it. Okay. You're asking only formula of IRR. So just projecting this information in the formula. Is that your query? Okay. So your query is the definition. See, internal rate, the definition of internal rate here is where the IRR equals to, it means that present value of cash inflow is equal to the present value of cash outflow, nothing but investment. See, it means what I am trying to say, let us assume that the present value here we got it as 1,72,658, right? And what is our investment? 1 lakh. It means what I am trying to say, if you consider the discount rate at 8%, we are not getting zero. We are getting a positive increase. It means the value, the present value of cash inflow is 72,658 more compared to the investment. But IRR is a point at which these two will be equal. It means instead of getting 1,72,658, your present sum of the present value should be only 1 lakh. So here the main objective of calculating IRR is what is the rate of interest? What should be the IRR at which these two will be equal? So once again, I repeat, see, with this particular procedure, definitely certain variation will be there. In order to get exact IRR, we will be using the IRR function in the Excel sheet, but that is not required for your ACCA standard. So do remember. So in simple, what I'm trying to say, if you consider discount rate, if you consider the discount rate at 22%, 22.11, then there is a possibility of getting IRR, nothing but NPV is equal to 0. It means your investment of 1 lakh will be equal to the sum of present value of 1 lakh. Shall we try with this 22 once so that you will understand? Shall we do that? Suppose here I am taking the discount rate. Discount rate at the rate 22.11%. I hope you understood what I am trying to do here. So 1 divided by Then for second year, Am I audible, students? Sorry, there was a network issue. Am I audible? Hello. 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 Am I audible?
Yes, sir.
Yeah, yeah. Sorry, there was a network issue. My connection got disconnected. Yeah. Yes. So here, where were we? Yeah, we are calculating the present value at the rate of IRR. And Hadi, I can see that you asked me a query regarding IRR. Can you know? Let me know what is it? Because we calculated IRR and we got it as 22.11%, and we are considering this 22.15% as a discount. Okay. Yeah. Now the present value would be, so same we'll be doing for many PA. And if you calculate the sum of these, so here you can see we got approximately 1,15,828, right? So it means it is very difficult to get the exact IRR. But here, if you see, because 22.11888 something, it is around 6 to 7 decimals are there. So, but I consider only 22.11. So if with that I got a 1,15,000. But if I would have considered the total percentage, it will be very near to 1 lakh. It means that the sum of the present value of the cash inflow will be equal to the investment. So that's why we assume that 22.1111108955, this will be the exact IRR at which NPV will be 0. I hope you understood the concept. Is that clear? Say, don't just do remember this calculation is only taken only to explain the IRR method. So generally we won't be doing this. So just by applying this formula, we got IRR, that's it. But just I want to show, if you consider the 22.11 exact value of all the decimals, then your sum value will be equal to your investment. Hope you understood. So if you have any query on this, let me know. Yes. Any questions? So shall I give a small illustration? Will you try? Am I audible? Hello. Hello.
Yes, sir.
Yeah. So any query on this IRS application? So just I will be giving a small illustration. So I want all the participants to please try. Investment 50,000. A discount rate 7% and 12%. Then cash flows. Let us assume that only 3 years are there. So the project cash flow, project lifeline is only 3 years. Yes. So just calculate the IRR for this. I want everyone to please try. So I hope you started trying this. So can anyone let me know NPV at lower rate of interest? Lower rate of discount? 6,820. Okay. Okay. So NPV at 7%. Okay. So at higher rate, 6,820 and 19. And so do everyone got the same answer? So lower rate at 10%, it is 6,820, and at 12%, it is 1,970. Here, Tarun, I believe you might have considered the present value, some of the present value. Here I am expecting you to give the NP. So do everyone got these answers? NPV at 7%, 6,820, and NPV at 12%, 1,970, sorry. Yes. So you mean to say 14% as IRR? Yes, Naina?
Yes, sir.
Okay. So I'm expecting other participants to please let me know your NPV at 7% and 12%. So 7%. And you should be very careful when you are giving the formulas also, because there might be a possibility if you didn't executed the right formula, you might be getting a wrong right and wrong answer. Are you sure? 14%, Naina? Okay. NPV at 7%. Okay. Let me do that. Okay. So once again, I am solving this. I am calculating the NPV value. So just see this. So first, just I am recalculating. So whoever got confused, you just see. First, I need to take discount factor at the rate of 7%. So 1. So present value at the rate 7%. Yes, yes, Naina, once please check with your answer. So here NPV at 7%, because the total present value we got it as 85,403. Yes, here it would be 85,403 minus the initial investment 50,000. So just check with your answer. NPV at 7% should be 35,403. And similarly for discount factor at the rate of 10%, sorry, 12%. 1 divided by 1 plus 12%. Yeah, no issue, no issue. I always encourage the students to commit the mistake. If you commit the mistake, then only you will be knowing the concept. Don't worry about it. And I appreciate Tarun for letting me know. Very good. So the present value for 12% would be so it is 76,883. So NPV at 12%, 76,883 minus initial investment 50,000. So our NPV is 26.88. Okay. Now we should apply the formula. Now I want you to apply the formula. Just because every information is available now. So just try to execute in the formula. So if you want, just I am showing here. Here you can see. Just I am highlighting the formula. So instead
Sir,
of
is the IRR 27.776?
27.776. Okay. One.
Sir, it should be 35,404, no, sir, if you round off. The decimal is 9 in the end.
Yeah, it should be 404, but no issue. It is only less impact it will be having. Huh? No problem.
Okay.
Okay. Yeah,
Okay.
I agree with you. Yes, it should be 35,404. Yes, I agree with. Yeah, but no issue. That is what is this deviation is acceptable. Don't worry.
Okay, sir.
21 point. How much you got? Is this same 21.12 or is it different?
No, sir. I got 27.
27. Yeah, 21.12, 22%. Yeah. Uh, can you once check? I hope NPV is same 35. So I think instead of 403, you might have taken 404. Yeah, that is negligible, no issue. And at 12%, 26,883. Can you please recheck with your formula once?
Yes, sir.
Yeah, please. Now 21.12 and some students got 22%, no issue because I think you might have taken rounded values, so round of values. So no issue. And once check with your the difference also, difference between lower rate and higher rate. So it is 5%. Here the main objective is you should understand the formula, which is how we need to apply and what is the procedure. Because definitely we can expect a query from IRR calculation. So very, very, very important. And I request the participants, if anyone didn't understood it, let me know. I'm ready to explain it once.
So,
Yeah.
can the ending IRR answer in percentage vary, or does it have to be a particular number or percent?
It means that is deviation is acceptable. Is that the query?
And exactly is like, see, for this answer it says 21.12699 etc. percent, right?
Yes.
So can our answers vary like 22, 23, 24 or 19?
21.12 at 22 it is acceptable. 22. So if you get 23 or 24, then there might be some issue with your calculation.
So you're saying like if it's 21, 20 and 22 are also acceptable?
Exactly, acceptable. Correct.
Fine, sir. Thank you.
Yeah. And Srivardhani here, what is your query? Didn't get to open the bracket. Even Leela also got 27.7. Yeah.
Yes, sir. We got 27.77%, sir. And the calculation which we did was like 7% plus open double bracket.
Mhm.
Isn't it supposed to be like that, sir?
One second, let me check it. Oh, yeah, okay. I think you calculated like 7% like 35,403 or 404 divided by 35,404 minus 26,884 into. Now here the issue is if you calculate here we need to open the bracket before 7%, right? One second. I hope you might have calculated like this, right? Now in this case, in this particular formula, so first we are calculating the effect. Just 1 second, just give me 1 second. Yeah, a small just clarification here. Yes. Now, generally, NPV formula, there is a possibility of little confusion. Now, if you carefully observe this formula, so the first thing is whatever the changes in NPV at higher rate and higher, and the changes in the, it means the difference between the NPV at higher rate and see, it means what I'm trying to say, if you focus on this particular part. So the main objective of this formula is what is the proportionate change in the lower rate and the higher rate. So that's why we consider the NPV at lower rate and we consider the difference between these and then the discount rate percentage. So it is acceptable to use this particular formula. Yes, a small correction. It is not 21.16. It should be 27 points. So here we should not keep the bracket before this because to this particular lower rate, we are trying to apply the changes between the higher rate and the lower rate. So it would be appropriate to use this formula. Yes. So it should be 27.17, not 21.12. So please make a note of this correction. Okay. So just once again, just highlighting the formula, just see this. I hope you understood. See, whatever the change is there between the present value at a higher rate and the lower rate, that particular proportionate change with the change in the discount rate should be adjusted to the lower rate of discount which we also. It means that lower rate is considered as a base. So 7% is considered as a base to this particular base. To this particular base, we will be adjusting the proportionate change. So that's why it would be 27.77%. Okay. Any queries on this? I request the participants to let me know if you have any queries. Once again, do remember there is a possibility of confusion in this. Just try to memorize like this. First, we need to take the lower rate as a base. To this particular lower rate, whatever changes, proportionate change is there between the lower rate and the higher rate, that should be added to this particular base percentage. Lower rate is considered as a base percentage. So 7% is considered as a base. To this particular base, the changes, the proportionate change in the present value or the NPV of lower and higher should be adjusted to the base. Okay, so if you can memorize like base rate, then the confusion will be, there will not be any confusion in it. So I hope you understood it now. Yes. Tarun, I believe you also got same 27.77.
Sir, I took present value tables.
Okay.
So I got 27.84%.
Okay. I think generally there will be deviation from present value table and the calculation, because in the present value table, and I believe you might have taken only 2 decisions, right? Yeah. So any question on this? So before I proceed with this IRR, once again I repeat, you can't even think about an FM paper without a question on IRR. So please be what is this, clear on this. If you didn't understood any specific step, let me know. So these are the steps given for explanation. Now just do remember, to calculate the exact IRR requires a more complex technique. So best carried out using an Excel spreadsheet. So this will not be expected in your exam. So don't unnecessarily waste your formula. Okay, let me show the Excel sheet IRR formula 1 second. This is. So just I highlighted the formula. See. Now here there is a query, a potential project predicted cash flows given NPV at 50,000 at a discount rate of 10%. and $10,000, and I'm expecting you to please do this. I hope you can try. If you have any query, let me know. Now one more question. Investment is given and cash flows for 4 years is given. The requirement is calculate the NPV if the cost of capital is 15% and NPV at 20%, and use the NPVs you have calculated to estimate the IRR. So can I expect you to do this? Will you try? So I'm not asking you to try now, so you can consider it as your homework, and if you can get back to me if you have any query on this. Okay. Yes. Now, if the cash flows are even, shall I go with this even cash flow IRR? I'm expecting you to respond.
Yes, sir.
Yeah. Now, if the cash flows are even, it means if there is uniform cash flows throughout the life of the project. In that case, how we can go with IRR? So there is a simple technique for this. If the project cash flows are annuities, it means if the cash flows are uniform. So find the cumulative discount factor as initial investment divided by annual cash inflow. So here you can see find the cumulative as initial investment and annual cash flow. Find the life of the project and look along n years row in the cumulative discount factor until the closest value is found, and the column n in which figure is found is IRR. Now anyway, I will be opening the table and I will be showing this, but try to once understand these 4 steps. The first one is find the cumulative discount flow as initial investment. Now what does it mean? Now let us assume that your initial investment is 1 lakh. Okay, your initial investment is 1 lakh, and if you are expecting a cash flow of let us assume that 20,000. You are expecting a cash flow of 20,000 and your investment is 1 lakh. So 1 lakh divided by 20,000. So how much we will be getting? 1 lakh divided by 20,000. I hope everyone can easily say this. Yes, 1 lakh divided by 20. How much? Five. Correct. Now let us assume that the life of the project is 5 years. Life of the project is 5 years, and if you divide 1 lakh divided by 20, we got a value of 5. Now what we need to do with that? Let me open my table. Yeah. So one second. Here, just say this. So with an illustration, I'm trying to explain. Just say this. So here, when you invest, our initial investment amount is 1500. You can say this. Our initial investment amount is 1500, and our cash flow is 700 for a period of 3 years. Our cash flow is 3 years. And what is the life of the project? 3 years. Okay. So first 1500 divided by 7. That is investment divided by your expected annual cash. So we got a value of 2.143 and the project life is 3 years. So in this table, project life is 3 years. So just see this 3 years. How much value we got? 2.143. Now try to see this closest value. So this 2.143 at the third year. So where we will be getting 2.143? So what is the closest value? So here too we got 2.140, right? So our value we got it as 2.143. Here you can see. So this 2.143, the closest value is 2.140. At 19% we are getting this. At 19% for 3 years we got a value of 2.140. So this particular 19% we can consider it as internal rate of return. So if your cash flows are even, the first step is you need to divide your investment divided by annual cash flow. When you divide it, you will be getting a value. So in this case also, our investment is 1500, our annual cash flows is 700. If you divide it, we got a value of 2.143. This 2.143 and our life of the project is 3 years. So at 3 years, so N we should consider as 3. Here N value should be considered as 3 years. So at 3 years, we need to see where it is closer, 2.143. Here at 19%, we got it as 2.140. So we can assume 19% as our internal rate of. Is that clear? So this simple technique we can apply if your cash flows are even. Let me know whether you understood it or not. So here you can see the solution part. So the figure is 2.140. So we can assume that IRR is 19%. Any query? Yes. Suppose let us assume that life of a project is 8 years. Initial investment 8 lakhs. Annual cash flow let us assume that 15,000. Sorry, 1,50,000. Now, will you try? What will be the IRR in this case? Just I am projecting the table. %. Okay. So we need to consider N as 8. Okay. So how much value you got? 8 lakhs divided by 1,50,000. Yeah, it is 5.33. Perfectly correct. And at 8 years, so where we'll be getting 5.33? Yes, 10%. So our internal rate of return would be 10%. So I hope IRR calculation for event returns or event cash flows is clear. Yes. Now the next one is, if you are calculating the internal rate of return for the perpetuity. So how to go with this? It means if there is no specific life is given. So if you are expecting the cash flows for foreseeable future or for a long period of time, so how to calculate the IRR? So here IRR for perpetuity will be annual cash inflow. So whatever cash which you are expecting divided by your initial investment into 100. So this is just like our return on capital employed formula. But in case of return on capital employed, we consider the profits, but here instead of profits, we are considering the annual cash flow. So that is the only difference. So internal rate of return for IRR with perpetuity would be annual inflow divided by initial investment into 100. And don't expect this IRR for perpetuities in your exam. Okay, this simplified method will not be given. So this is the formula for perpetuities for IRR. So I hope it is clear. Any query? I am expecting the participants to respond. Hello. Yeah. Now we'll discuss the advantages, and I believe you can try this test your understanding level. So find the IRR for an investment of 50,000 if the inflows are 5,000 in perpetuity. So cash inflow is 5,000, and if it is 8,060 for 8 years. I hope you can do this. Now, if you see the advantages and disadvantages of IRR. So the first considers the time value as NPV. IRR is also considers the time value of money and is a percentage, especially for the decision makers. It is very easy to understand because it is expressed in percentages. No, absolute amount is not given. So it is easy for the decision makers to consider it to understand the percentages and uses cash flows, not the profit. So like net present value, IRR also uses the cash flow, not the profits. Next, and it considers the whole life of the project, because like a payback, it won't be considering only the payback period. It considers the total life of the project and means a firm selecting projects where IRR exceeds the cost of capital should increase the shareholders' value. Now it means that a firm always need to select those projects which is having higher IRR compared with the cost of capital. Because if a project can generate higher, if the project IRR is more than the cost of capital, now definitely we can assume that it will maximize the shareholders' wealth. So these are the advantages, and I don't think you have any query in the advantages. And when it comes to disadvantages, now let me explain the disadvantages in detail. Now it is not a measure of absolute profitability. Say project of $1,000 invested now and paying back 1100 in a year's time has an IRR of 10%. Now if the company required return is 6%, then the project is viable according to IRR. But most business would consider the absolute return too small to be worth the investment. It is nothing but whatever the return which we are getting, the 10% would be too. Of course, it might be more than the cost of capital. Then interpolation only provides an estimate, and an accurate estimate requires the use of spreadsheet program. So as I mentioned, it is very difficult to use. It means by using the formula, interpolation method is nothing but the formula which we considered. Lower rate plus NPV at lower rate divided by the difference between the NPV of lower rate and higher rate into the change in the percentage. This is nothing but interpolation. So it is very difficult to get an accurate value by using the interpolation method. So we can get it only by using the spreadsheet program. So the cost of capital calculation itself is also only an estimate. So if the margin between the required rate and IRR is small, so the lack of accuracy could actually mean the wrong decision is taken. Suppose these are only the estimate. Let us assume that the cost of capital is 7% and we got IRR as 7.3%. Once again, I repeat, the cost of capital of the company is 7 and our IRR is 7.3%. Only very less margin is there between cost of capital and the IRR. Now, normally, if IRR is more than the cost of capital, we will definitely consider the project as feasible. But in this case, there is only less margin. And there is a possibility of deviation also because it is an estimate. So if you make your decision on the basis of the higher IRR compared with the cost of capital, there might be a chance where the senior manager might end up with a wrong decision. So this is also one of the disadvantage. Next, if the cost of capital is found to be, the example which I gave, so I hope you might have understood that. Then non-conventional cash flows may give rise to no IRR or multiple IRR. So in order to understand this non-conventional cash flows, an example is given. A project with a outflow at T0 and T2, but income at T1 could depend on the size of the cash flows and have a number of different profiles on graph. Now, even where the project does one IRR, it can be seen from the graph that the decision rule would lead to wrong result as a project does not earn a positive NPV at any cost of capital. It means what I'm trying to say, suppose there will be certain projects where you need to invest in multiple periods. Multiple periods in this, normally in most of the projects, we will be investing. We are assuming that the cash outflow will be only at T0. It means at the beginning of the project. But some project requires the cash outflow. It means requires the investment at the middle of the year also. So here you can see if the cash outflow is at T0 and T2, then there is a possibility of multiple internal rate of returns. And these multiple internal rate of returns, because these are estimates, of course, it might be more than the cost of capital, but it means that it won't be giving a positive NPV. Hello. Hello. Yeah, so please once go through this highlighted paragraph. Now here, this is about the situation which was speaking here. So two IRRs. So for a better understanding, you can see this point also. Let's be focused on it. Use of IRR contains an inherent assumption that once cash flow starts in the form of investment, they will be reinvested at the same level as the project's IRR. So, but this may be an unrealistic assumption. For instance, a business may have a cost of capital of 10% and has undertaken a project with an IRR of 20%. So assumption in the IRR calculation is that cash flow generated by the project will be reinvested at an equally nothing but beneficial level of return as this project, whereas the cash is more likely to be invested in projects that return at an above rate of 10%. Now it means what I'm trying to say. Normally, if a cost of capital is 10%, and if you undertake a project and if its IRR is 20%, so it means that IRR calculation, the cash flow generated by the project will be, it means whatever the cash which is generated from that particular project will be reinvested at an equally beneficial level of return as this project. It means the current project is giving an internal rate of 20%. Now, whatever cash flows which are generated from that, that will be reinvested at 20%. But in well, if you see the facts, the company will prefer to invest that particular cash flows from the project at a rate which is more than the cost of capital. So it means when it comes to reinvestment, so IRR is not beneficiable if you are assuming that the cash flows are reinvested, because we may not be reinvesting the cash flows at the rate of 20%. Always again we go to the first basic principle, that is the project which generates more than cost of capital is preferable. Always it is very difficult to expect a project to give the same return which is currently what is this derived from the existing project. That is practically not possible. If I start a project and if I got a return of 20%, and when I'm going for the reinvestment, it is not possible to expect same 20% from a new project. Again, I will be going to my ground theory, that is investment, the return should be more, IRR should be more than the cost of. Is that clear? Any question on this? Yes. Hello. Now, if you see the NPV versus IRR, generally both are considered as an advanced investment appraisal techniques. And in practice also, we do consider these advanced investment appraisal techniques, because here we consider the time value of money. So compared with the traditional techniques like payback period and ROC, it is preferred to go with these. But however, if you see investment at the discount cash flows and are superior to the basic technique discussed in the previous chapter. However, only NPV can be used to distinguish between two mutually exclusive projects. Now it means that mutually exclusive. Can anyone let me know what do you mean by mutually exclusive projects? What does it mean? Mutually exclusive means. Yes. I hope I am audible. I am very surprised that I am not getting any responses from the participants. Should I assume that you already exhausted? Yes. Yeah, yes, Farhan. We can only go with one. It means, let us assume that if you have a limited fund of $1 lakh to invest in a project, and if you have two alternative projects, if you want to go with one, you need to forego the second one. So mutually exclusive means if you want to undertake one project, definitely you need to forego the next one. So in case of mutually for exclusive, always it is preferred to go with NPV, because NPV express the performance in absolute terms, because we can clearly know the return from those projects. So always it is preferable to go with NPV in case of mutually exclusive projects, because there will be very less negligible IRR rate. Suppose project, what is this? A might get an IRR of 10.1%, and project B might get an IRR of 10.2%. So very negligible percentage is there between the IRR. So it is very difficult to consider IRR as a base to make the decision. So in that case, we always need the absolute terms. It means what is the exact amount of return which we are expecting from the project. So if you go with the IRR, we can clearly know the absolute terms, and we can use it to make the decisions. Is that clear? So when if you are comparing the credibility of NPV and IRR, so IRR is a superior method compared, sorry, NPV is a superior method compared with the IRR. I hope you got my point. Yes. Now there is a requisition here on this information. I'm giving this illustration 12 as a homework. I request everyone to please once go through this, because here we should calculate the accounting rate of return, and we should also do NPV by assuming 10% discount rate, and we should also calculate the internal rate of return. So will you try this? Yes. Test your understanding so well. Okay. You want me to explain this one? See, in this test your understanding to well, very, very simple. See, three projects are given: project E, project F, project G. Okay. Now, what is the requirement for each of the projects? Suppose if you take project E, we need to calculate the payback period for project E, and we should calculate accounting rate of return. Now, I hope you might have recollected the procedure for calculating the payback period, because here cash flows are even. The total life of the project is 4 years, and the cash flows are even 50,000, and your initial investment is 125 in case of project E. So we should calculate the payback period, and same we should calculate the accounting rate of return. Okay, but in this case they gave the cash flows. So do remember, they gave the cash flows excluding return on capital employed, nothing but excluding the accounting rate of return. For all the other investment techniques, we generally use the cash flows, but for annual rate of return or for accounting rate of return, we need the profits. Once again, I repeat, we need profits for calculating the accounting rate of return. Now, in this case, so let me show. Suppose for project E, So total 4 years are given. Year 1, 2, 3, 4. Cash flows are 50. Right? Now, as I mentioned, for calculating accounting rate of return, we need profits, not the cash flows. So whatever cash flows are given, we should convert it into profits. We need to convert the cash flows into profits. And here they asked us to calculate accounting rate of return based on average investment method, right? So before applying the formula, first we try to convert it into profits. Can anyone let me know how we can convert a cash flow into profit? Anyone? How we can convert?
Minus depreciation.
Very good. Is it yeah, minus depreciation, but how we will be getting depreciation here?
Cost of asset minus residual value divided by life of the asset.
Very good. So depreciation is equal to cost of asset divided by life of. So in this case, initial investment represents the purchase of plant and equipment. Realizable value will be 20% of initial cost. So the residual value will be 20% of the initial cost receivable in addition to the above flow at the end of the life of the project. So the depreciation would be 125 minus 20% of cost divided by project life is 4 years. So our depreciation would be 25. So the profits, as you said, this depreciation should be deducted from the cash flows. So the final profit should be 20. I hope you understood this profit calculation. And what is the formula for ROC? Nothing but accounting rate of return or ARR. They asked us to apply the average investment. So can anyone let me know the formula for average investment? We already discussed this formula for ROC, return on capital employed, or accounting rate of return.
Average annual profits before interest and tax divided
Very
by
good.
capital investment into 100.
Average profits divided by average investment, right? Very good. Now, how we will be getting average investments?
Into 100.
So anyway, average profits we know that is 25, but how we will be getting average investment? Scrap value plus initial value divided by 2. Very good. So do we need to add the scrap value or we need to deduct? So we should be very, very careful here. Now most of the students, they are confused in this. Do we need to add or subtract the scrap value? Yes. While calculating the depreciation, we will be deducting the scrap value. But for calculating the average investment, we need to add the scrap value. Okay. So residual value divided by. So our investment 1,25,000 divided by residual value, how much we got? So just I projected the residual value formula also, don't confuse. Okay. So the finally our average rate of return would be 25 divided by 75 into 100. So this is the only adjustment point you need to consider, and remaining payback period and net present value, I hope you can go with this. Don't ever try to convert again, because for other methods, for payback and NPV and for IRR, we need cash flows, not the profit. Only for average return, nothing but average rate of return. We need to consider. I hope it is clear. And I believe you can go with the other three. Yes. But they have not given. Any effect on payback period? Yeah, here no, not required, not necessary to consider. And one more question here, for calculating IRR, they gave 10%. Now just assume this 10% as your lower value, and you can take any percentage at its higher value. I hope you understood that, right? See, and one more thing, especially for E and F, especially for E, how we can calculate the IRR? Okay, what I will be doing, just I will be projecting its solution, I will be explaining so that you won't have any further confusions. I think it would be better. See, first we'll go with the project E. Now in case of project E, if you can recollect, all the cash flows are even. All the cash flows are even for project E. Now in case of even cash flows, how we can go with IRR? We do have a simplified method, right? So we discussed that. Right? Now here you can see, yeah, initial investment into annual cash flow. And in this case, because there is an additional value which should be considered. So let me explain the NPV and IRR for all these projects. Suppose for project E, our NPV is 50K each one. And because the annual cash flows are same, now no need to convert every value into the present value. Directly we can refer the annuity table, and for 4 years we can find the annuity table value. That we are here, we got it as 3.170. And in the question they mentioned that after the project, we are expecting to realize 20% of its initial investment. Now, for calculating this 20% in the sense we got 25, but do remember we will be considering only the present value of the fourth year. Okay, let me show this. Our rate of interest is 10% and our life of the project is 4. So it means that every year we are receiving 50,000 as cash inflow. In addition to that, whenever the project is closed, whenever the project is dismantled, we are expecting a residual value that is 20% of your initial investment. So that is considered residual value. So that particular amount we should go with this. What is this discount factor? It means the discount factor for the fourth year, that is 0.683. Is it 5 years or 4th year? Let's see. What is the life of the project? 4 years or 5 years for project? Okay. So here they gave life of the project as 5 years for project E. And do remember, in this case, the residual value which we are expecting to receive at the end of the year. So there is a small correction. I want everyone to please make a note of it. Suppose instead of giving this 50 year, let us assume that this 50 year is not given. 50 year is not given and up to only year 4 is given. Now in that case, if they give any additional information regarding the realizable value, suppose if they mention that initial investment represents the purchase of plant and equipment whose realizable value will be 20% of the initial cost. Now, if they would have given like this, and if they didn't give any Wi-Fi, nothing but year fifth year, now we need to assume that the realizable value was included in the fourth year cash flow, unless and until they gave extra information about this. Once again, I repeat, instead of 5 years, suppose if they would have given only from Y1 to Y4, and if they gave additional information of realizable value of 20%, we would have assumed that this value was already included in the 50, that is the cash flow of the project Y. But because they gave a separate, it means that we can assume that project E is having 5 years. So in the 5th year, we are expecting the residual value of this project as our cash inflow. So that is the reason we considered it separately. If they would have not given, no need to consider this residual value of 20%. I hope you understood my point. Okay. So here you can see receivable in addition to the above cash flow at the end of the project. They clearly mentioned this particular point. So that's why we are assuming we are adding this when we are calculating the NP. If this point is not given and this information is not given, then just ignore this realizable value of 20%. Yes, did you got my point? I'm expecting the participants to respond. Hello. Okay, let me explain this once again. So here the question is, do we need to consider the realizable value for calculating net present value? So the first question is, if there is any additional year is given. In this case also, we received the cash flow only for the 4 years, and they gave actually the project life is 5 years. And first 4 years cash flow is given. 5th year, we are expecting the residual value as our cash flow. And in the question, they clearly mentioned that receivable, this residual value is receivable in addition to the normal cash flow. So that's why we need to consider this realizable value for calculating NPV. If this statement would have not given, no need to consider this realizable value for calculating the. So this was the point which I'm trying to explain. Okay. Pooja, I believe I addressed your query, no?
Yes, sir.
Yeah. And see, here we do one thing. I request all the participants to once try it. So tomorrow, first to 5 minutes of the session, if you find any difficulty, I will be clarifying this because I can identify that most of the students are already exhausted. So that's why I'm not getting the response. And one more query here is regarding the practice platform. I didn't get you. What practice? Are you speaking about ACCA practice platform?
Yes, sir. You said that we could go and like try out how to write
Yeah,
the
yeah, yeah.
exam.
Now that you need to access with your login credentials, not in the LMS. I believe you might have received login credentials from ACCA, user ID and password.
Yes, sir.
So with that user ID and password, you can directly open. Okay, shall I show it once?
Yes, sir.
So once you open your website, just go to the students section. Study support resources. Just go to ACCA qualification. Suppose financial management paper is there. Just click on the financial management paper. Here you can see question practice, ACCA practice, right? Just click on this. Now here you can see login into the practice platform. So with your user ID and password, you can. Did everyone understood, or you want me to show it once? Yes. Naina, I hope now you got it. For accessing this, you need to open the ACCA website, not from the MS. Okay. Okay, so I request the participants to please go through illustration 12 and other illustrations. And tomorrow, first 5 minutes, we'll have a discussion on those. Okay. Yeah, I will be uploading it very soon, Tarun. So maybe this week, whatever sessions we completed, all those sessions will be recorded. Okay, I will be uploading it in the link. So by end of the week, I will be doing it. Okay then. So that's it for today. Have a good day. And I once again I repeat, I want everyone to please go through the illustrations. So first 5 minutes of tomorrow session we'll discuss. Okay. Yeah. So So that's it for this. I'm ending the session.